Mortgage rates fell this week to hit a 3-month low. Now, this comes as the prices in the housing market continue to rise. Here with us to discuss all of this is Doug Duncan, Fannie Mae chief economist. It's good to have you here again, Doug.
Thanks.
There's a double-edged sword when mortgage rates are falling, because that also inflates sometimes the prices, and we're already in a lot of places at levels that people call unaffordable. So what does this mean for people who might be buying or selling?
Well, you're absolutely right about that. And the way to think about the relationship between those two things is it's driven by the greater strength on the demand side than the supply side. So when borrowers look at the size of payment that they'll have to make to buy a house, it has an interest component and a principal component. So when they figured out what payment they can afford, if interest rates fall, the interest component of that payment shrinks so they can bid the price of the house up, and that shows up in the principal part. That's why prices go back up. So the decline in rates from an affordability perspective helps, but it's partly offset by prices. That said, it's still the expectation in the housing market is it will pick up strongly this year, probably about a 5% increase in new home sales and a 1.5% increase in existing home sales. That's a pretty good year because these are historically low interest rates.
I want to talk about the spectrum of housing, right? Because Fannie Mae itself, I know you as an economist focus on the entire housing market. Fannie Mae itself focuses on the sort of lower end of the housing market, right? Capped. It doesn't handle jumbo mortgages, which
Correct.
are for the pricier homes. So with all of the information that we are getting about sort of mid to lower income consumers, the fact that their wages are rising more quickly than the rest of the market, for example, but anecdotally, we also hear that a lot of them are sort of on a knife's edge in terms of expenses. How is all of that translating into that segment of the housing market?
Well, there's no question that the demand is being driven by lower income, first-time home buyers. The millennials, frankly, started in about 2015 as the driver. Because of where they are in their life cycle, their incomes are lower because they're starting to grow. So the credit analysis business is to determine who's on a knife's edge, and getting into a mortgage would actually tip them over if there's a problem in the economy. So you've seen some things in the news today about credit scores and the rejiggering of credit scores. That's key in trying to figure out what's sustainable in terms of a mortgage. So you don't just want to give people a mortgage, you want to make sure it's sustainable for them.
Is that going to are these new standards going to do a better job at that?
Well, I think they will. I think it's a response to the fact that we've had a long expansion now where there was a big upset in the housing market, and people are testing whether this experience in this expansion is stable or not. So that's why you're seeing an exploration in that, but it's only one piece of the puzzle on whether somebody can pay back their mortgage. There are other components of that too. It's the composition of debt. Student debt, is that an issue for you? Are you managing that well, and is it going to tip you over if you apply for a mortgage? So it's a complex calculation. Credit scores are a piece, they're an important piece, because they say something about your willingness to have paid back past credits.
I want to talk about the supply of new homes. We were talking about the home builders just doing phenomenally well, especially this month as we've seen the long end of the yield curve come down. And Lennar happens to be one of the best performers in the S&P 500. But we had a situation last year where there just wasn't the supply of new homes coming onto the market. Is that situation being resolved? Are we lengthening that window into this year?
It's still true that there is less supply than there is demand for. The problem that builders have is traditionally the bulk of the building builders have done is to the move-up buyer. A small share of what they have done is for entry-level buyers, but typically an entry-level buyer will buy an existing used home. They'll put in some sweat equity into it. That builds them some equity for the move-up, and so there's this kind of a ladder. Builders typically build further up on the ladder, so the square footage they've been building has been shrinking, so they're moving toward that entry-level borrower. But if you think about their sales staff, when you walk into the sales office, they're going to offer you, do you want granite countertops? Do you want finished basements? Do you want, what kind of paneling do you want? Those are all options that move-up buyers would consider. Okay. If you're an entry-level buyer, you're looking for basics. 3 bedrooms, a bathroom, and a garage.
All right. Doug Duncan is the chief economist at Fannie Mae. Thank you for being here on The Move.
Thank you.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.